normally it's just flat. It's just flat, 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 flat. And then suddenly you get the breakout and all FOMO breaks loose. That is a signal of retail coming in. That they are very, very FOMO driven. 2017, very much the same. And every cycle prior is like when it goes vertical. You're going to mute the pullbacks. I think it's going to become more stable. Also, we're bigger, right? We're at 2 trillion market cap instead of 1 from last cycle. So it becomes more stable by nature. But then you got to look at what kind of environment we're in. Are we driving up a rough terrain, or are we on a smooth highway? And what I'm saying is the system, this truck called Bitcoin, is inherently more stable. The suspension's good. Everything is robust. But we're about to hit some off-roading. And so it may look more unstable. It's just everything's going unstable because we're driving on a road called global macro now.
Everyone thinks they know how crypto works. Every 4 years, like clockwork, Bitcoin halves, prices surge, retail rushes in, altcoins follow, and chaos erupts. That's the familiar script we saw in 2017 and again in 2021. Now we're about 140 days out from mid-November, the historic peak window. By this point, the market should be soaring. But it's not. Yet Bitcoin just smashed through $116,000, a new all-time high, leaving $113,800 far behind. It's nearly doubled compared to a year ago. The price action screams bull run, but the energy feels quiet, almost eerie. That silence is exactly what on-chain analyst Willy finds unsettling. He's raising the alarm that this cycle isn't following the old rules. The usual retail mania is missing, no TikTok traders, no viral hype trains on YouTube, just calm, steady accumulation. So who's buying? Not the crowd. It's institutions. BlackRock, Fidelity, even sovereign funds. They're stacking Bitcoin as infrastructure, not a quick trade. This market move isn't driven by hype, but by billion-dollar flows. Wu's insight cuts deep. The lack of euphoria might not be a warning sign. It could be the signal. If this is the top phase, where's the mania, the FOMO, the madness? Maybe we haven't peaked yet. Or perhaps this is the new peak, a quiet, institutional takeover catching everyone off guard. Waiting for fireworks might mean missing the moment entirely, because this bull run isn't loud, it's stealthy. And it might be your last real chance to ride the wave. Now, let's dive into clips from Willy Woo's session for deeper insight. Still paying taxes on your crypto gains? What if you didn't have to? With ITrust Capital, you can buy and sell crypto inside a tax-advantaged IRA, giving you a smarter way to grow your portfolio without worrying about capital gains tax. That's why they're the #1 crypto IRA platform in America, with billions in tax-advantaged transactions. There are multiple ways to fund your account. You can make a contribution, transfer an existing IRA, or roll over an old 401k or employer plan. You'll get access to a wide range of digital assets, low fees, and 24/7 trading, all backed by secure, one-to-one asset ownership with institutional-grade custody. And if you have questions, ITrust Capital offers 100% US-based customer support with real people ready to help. Click the link, use code DOSE7, and get your $100 funding bonus today. Start building your crypto wealth, tax-advantaged, with ITrust Capital.
Every cycle is different, right? Like last cycle was kind of the birth of institutions coming into space, and paper derivatives made a huge impact on the price. This cycle, we've got spot dominance coming in from TradFi institutions. That's MicroStrategy, BlackRock's ETF, all these other treasury companies starting to stack, and nation states. So it is different. And actually, can you see the chart right now? Yeah. So you can actually see it in this chart, because this line is actually the amount of capital that's been stored inside Bitcoin. We can measure that easily on chain. We can assess when did they buy the coins, what cost basis. So what's different about it? It's just a squiggly line right now, but I can see it's markedly different in this cycle. You see this? Normally it's just flat. It's just flat, 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 flat. And then suddenly you get the breakout and all FOMO breaks loose. That is a signal of retail coming in. That they are very, very FOMO driven. 2017, very much the same. And every cycle prior is like, when it goes vertical. And we haven't seen that. But what we have seen is around the time of the BlackRock ETF, there's a staged, consistent buying by the institutions. There's no sort of FOMO right now, and what we're looking for is this to go vertical, as in the capital going into the network starts to go exponential, driven by retail FOMO. What's different this time is that, look, it takes billions of dollars to move the needle right now. For every, dollar that we put in here in this cycle, there, we've got to put in 10 now. So I think a lot of this depends on the big boys and institutions to climb vertically. And so I'm not convinced that we'll go absolutely vertical like the old days. But there may be some sort of retail FOMO coming in, and it'll overlay on top of this sort of gradual stage buying that we're seeing right now. And in terms of, you're saying November. So market tops are really unstable. Volatility is climbing. There's all sorts of interactions where everyone's getting FOMO. It's very emotional. And then you've got to look at liquidity. How much capital is actually coming in? How much money's being printed and spare capital coming into the network? And so it's very difficult to pick the top timing-wise and target-wise, almost impossible. What you see here is a risk model, right? The risk model is taking into account liquidity. This is my measure of liquidity. It's looking at how much capital is coming into the network. It's taking a look at the pricing structure within Bitcoin. You're seeing here, like the buy side of liquidity, and tops happen when liquidity starts to drop out relative to how big, the market capsizing. So you can see here that in the early stages of the bull, the risk is very low because there's strong liquidity relative to the pricing. And then in the late stages, it starts to chop around a lot. And the bear market starts when we're at 100% risk. And so we have actually triggered into that phase. So you're absolutely right that we're in the later phase of the bull market because we're now in a risky zone. You can consider that unstable. The liquidity is not providing that buy side support for number go up all the time. You can get pullbacks, you can get sharp ones. We're in a relatively nice dip right now in the risk, which means the liquidity's picked up. So I do expect that inside these kind of pullbacks, they'll increases in liquidity amongst the late cycle. So when you get that pullback, there's room for us to move up. And so I'm pretty sure that we're going to break all-time highs. If you flick to a TradFi view of it, there it is again. This is a traditional markets, S&P 500 now breaking all-time highs. So we've had a decent pull out of this pullback, and we're now going high. And so that's really anticipation, I think, of money printing that's going on. That's not going on, but is expected to come in. But we need to watch where the top is. And if anyone's been following Henrik Zeberg's work within global macro, he's saying the ship has hit, the Titanic has hit the iceberg. It hasn't sunk. It's filling up water, but we've got a bit of time and we're going to get a blow off top. And so I work with them daily within Swissblock because we do market intelligence publications for institutions now. And with that context, this is data backed within economic forecasts and data that is coming in. We are late cycle, and we do expect this to top. Presently, there's a good opportunity for a market top in September going into October. It's very hard to predict the top. I don't think this cycle is going to be so predictable. Maybe we get the November, December, but if it does not, crash early, I think it'll crash late, maybe March. I don't think it's a fun cycle anymore. Let's address this. It's like, again, I said that it's institutionally driven. And actually, that could be a whole lot of Bitcoiners and crypto people selling their assets and buying Bitcoin treasury companies because they have large multipliers on Bitcoin's gains. So you kind of think of, like, if you're going to be trading crypto, altcoins, shitcoins, whatever, meme coins, anything shitty, in a casino. That those are the things that move, and they haven't moved this time. And like what's really taking off are things like Metaplanet, MicroStrategy early in the cycle. These things took the attention, and you think about that. That is like a vacuum cleaner of liquidity that's being sucked up amongst the crypto people. They're buying in securities, and then they're buying back Bitcoin in a very staged, dollar-costed way. So you could see that as a big dampener on the fun, which is the rampant FOMO and then massive tops and then coming back down. So that is one theory.
Willy Woo doesn't just theorize, he supports his views with data. His on-chain analysis shows Bitcoin rising steadily, not spiking like in previous retail-driven cycles. The sharp, vertical rallies driven by retail investors are gone, replaced by a slow, methodical climb led primarily by institutions. This shift is driven by treasury buyers like MicroStrategy, Metaplanet, and others acquiring Bitcoin for their balance sheet. While this seems bullish, it also drains liquidity from the broader market. Instead of investors buying Bitcoin directly, they purchase shares in these companies, which then gradually accumulate BTC. This indirect buying channels liquidity differently, leading to less volatility but greater underlying risk. That risk is amplified by some firms using leverage and debt to fund their purchases. Wu points to Metaplanet's EVO fund as an example. If market conditions worsen, these players may be forced into rapid sell-offs, potentially triggering a domino effect similar to past crashes in 2018 and 2022. Though the risk is masked behind corporate entities and polished presentations, it remains very real and poised to surface with the wrong market trigger.
I think there's two types of leverages here, right? One's a premium. We've experienced that with the original Grayscale ETF. It
Yes.
traded a premium and then it traded a discount. That you could call that leverage. I just call that a premium or a discount. And if you're holding that share, well, it feels like your face value of your shares are dropping hard, and it looks like leverage is unwinding. But that's just a premium. Leverage has a downside called liquidation. You lose your asset, right?
Yes.
And you need to look at the details of these treasury companies. If you're a micro sailor and you're being smart, he's going, hell, I've survived one bear market and I don't want to have that feeling again. I'm going to push out my debt 8 to 12 years now. So in the first bear market, no matter what, no liquidation risk. I'm going, what are the chances that Bitcoin's not going to double or triple, whatever you need to get that price back up over the next 10 years, right? And so that's pretty safe. That's kind of like the most robust debt structuring out of these treasury companies. And then you've got things that are running up 8 times MNAV, and are things like very clever financial engineering like Metaplanet, and they have liquidation risks for sure. If you look at how they're doing it, they're doing Evo fund that's operating like a hedge fund. They're playing spread when the price pumps. They sort of exercise their warrants. They when they exercise, capital goes back into the Metaplanet. They get a little kind of market neutralish yield. They're making money. Metaplanet's getting capital in. It's like an ATM on steroids. But what's happening is that they're taking big tranches of debt. Evo fund takes the debt. They send money back as the market runs up. What happens when the market turns? What happens if Metaplanet does not get, they're not safe when the market turns? They haven't got if they're at zero debt and they haven't done the next tranche, so no problem. But if they've got another $300 million of debt sitting there and the market's turning and Evo fund can't do their spread trade, they're going, hell, we can't exercise our warrants. We can't send money back there. Let's call back our $300 million of debt. And that's going to send all the way back to Evo Fund. That there's no 10-year window here. It's immediate. It's the maturity says X number of months.
That's the problem.
But they can call it back any day. No one's looking at the debt structuring. So when they call that back, what's Metaplanet going to do to fit that $200 million bill? They've got to sell their Bitcoin. And that starts a cascade. They're going to get liquidated on the Bitcoin if they get caught flat-footed, But they might not. They might be pretty smart because they absolutely bought the bottom. I think that when this market turns, the absolute pristine collateral on the planet will be short on Bitcoin treasury companies. You're going to get like 8x leverage for free. You don't have to pay that kind of funding rate. And as the MNAVs collapse from 8x to 1 or even below, that's That's a very cheap short. Your downside's limited because you don't have to put a position on that's very big, and you're going to get 8 times or maybe 10 times. If it's going below MNAV. So yeah, it's an opportunity as well if you want to hedge your bitcoins and you go, I can maybe not sell my bitcoins and put a short at the top. That's hard, by the way, timing the top. But as we're going down the other side, yeah, absolutely, it's not going to be great. And if you're listening to Henry Zeberg, we're in a business cycle recession coming. And last time we did that was COVID, and before that was the world financial crisis, 2008. COVID was a massive liquidity injection, and it happened early before COVID actually hit. Now, if you're injecting late, I mean, we're going to have something between 2008 and the Great Depression, right? So that's the worst case scenario. And so all liquidity is going to be sucked out of the system. So Bitcoin, though we're thinking it's much more robust this time because there's less toxicity in the system relative to the last cycles. Last cycle was pretty bad. We've got a big liquidity extraction that's going to be pulled. A lot of capital is going to come out of risk markets in this cycle, and that could cause us to pull back a lot harder than anyone thinks. There's talk about maybe only pull back 30%, maybe 50%. It's a micro bear market for Bitcoiners who are used to 85% plus pullback. So we've got to keep that in mind. You're going to mute the pullbacks. I think it's going to become more stable. Also, we're bigger, right? We're at 2 trillion market cap instead of 1 from last cycle. So it becomes more stable by nature. But then you got to look at what kind of environment we're in. Are we driving up a rough terrain, or are we on a smooth highway? And what I'm saying is the system, this truck called Bitcoin, is inherently more stable. The suspension's good. Everything is robust. But we're about to hit some off-roading. And so it may look more unstable. It's just everything's going unstable because we're driving on a road called global macro now. The last two bear markets since 2018 was my first, no, then my second. My first bear market I was accumulating, right? That was 2014. 2018, I went to dollars, stable coins. The last cycle also went to stable coins. Actually, the last cycle was stable coins and yield, right? It was, we launched our fund of funds, which was market neutral trading. So in a bear market, you might get 5-10% doing arbitrage trades in crypto whilst everything's collapsing. So my plan is to do a bit of that. My plan is to potentially diversify that into lending, like Bitcoin collateralized lending, which is pretty stable, low risk returns without exchange counterparty issues. And then also we have the capability here now to hedge a little bit by sorting things like, I aforementioned MetaPlanet, that's 80x MNAV. So a little bit of that, wouldn't go too heavy, but that's what I'm thinking. Yeah, way too early. You're going to get killed, right? By doing the short while holding your Bitcoins, you're basically selling to cash. And so you want to be late. You always want to be late because it's not clear whether it's a bear market until a bit further into it. You want to wait for the dead cat. Yeah, because the tops are unstable. 2017, we thought it topped at 10,000. A lot of people thought it would top. And then it ran up to 20,000 over 2 weeks, right? And that's how unstable tops are. So, but it was very clear when it dead catted and bounced to 12,000 from the 20,000, it was a proper bear market, and that would be the safe time to rotate out. You don't ever try to capture the top. You can give that money out. You can give it back. You're just risking too much.
So what's next? Willy Woo believes we're entering the final stretch of this cycle. His risk indicators, comparing liquidity inflows to market cap, show we're in the danger zone where past cycles peak. But the timeline is uncertain. While November has traditionally been the peak, this cycle's unusual structure means the top could come earlier, later, or drag on well into next year. Timing the exact peak might now be impossible. As for altcoins, Woo doesn't expect the explosive rallies of previous seasons. Institutions don't chase meme coins, they move capital slowly from Bitcoin to Ethereum and other major players, making alt seasons quieter and less volatile. Meme coins might still spike, but Woo warns they remain unstable and unpredictable. The bear market ahead may be less brutal than before, with expected crashes around 30 to 50% instead of the 80 to 85% drops we've seen in the past. That's due to stronger institutional foundations, but the broader economic picture is grim, with recession fears threatening liquidity across all risk assets, including Bitcoin. Wu advises investors to avoid trying to time the exact top. This approach often leads to losses. Instead, he recommends 3 key strategies. Shift into stablecoins and use yield strategies that don't rely on rising prices. Hold Bitcoin for the long term as it remains the strongest asset, and watch for shorting opportunities only after the peak is clearly behind us, targeting weak, overleveraged players. Despite the risks, Wu's long-term vision for Bitcoin is optimistic and far-reaching. He sees Bitcoin not just as digital gold or a store of value but as the future of money. A secure, decentralized currency immune to inflation and government control, operating without bank. He predicts Bitcoin's market cap could soar beyond trillions, potentially resetting the global financial system. The key takeaway? This cycle defies old patterns. Retail hype is absent, institutions quietly dominate, and hidden debt risks linger beneath the surface. Volatility is low, timing is tough, and uncertainty is high, but for those who stay the course, the greatest financial story may still be unfolding. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.